This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
I really encourage you to get involved with Jason and his team. The whole group over there is just fantastic. I started working with them probably 10 years ago. The main thing is get in the game, get started, get that first property or get 6. I think the world of this group. They've helped me a lot, and I think that you'll really enjoy the process.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Welcome to episode 1735. Our guest today is going to talk about some creative strategies for, well, I don't want to say retirement plans necessarily. This is pretty creative stuff, so I think you're going to enjoy that. So we will get to our guest, Damian Lupo, here in just a moment. But first, NPR, yes, the government-sponsored media outlet. NPR is reporting 2 days ago, I'm looking at an article entitled, "The Housing Shortage is Significant. It's Acute for Small Entry-Level Homes." And this is a good point. You know, you surf around the internet, you hear stuff in the media, you hear about a housing crash, you hear that the builders are starting to catch up with the demand. The supply is starting to meet the demand, and in a couple of years it will settle and the demand will be met. Because if you look at the number of housing starts, and if you look at the demand in the marketplace, and if you look at the current shortage, it's simple math, right? You just know that if they build a certain number of homes, and if your demand is a certain amount, and if the shortage is a certain amount, hey, you can do the math, right? Wrong. Wrong. Here's why. Because it depends on the type of housing. It depends on the location. It depends on the price segment. All of these things are hugely important. And what's happening here is, and this is not new, we've talked about it before, but I will just say it again, it is not profitable for builders to build entry-level housing. It's simply not profitable. Last time around, prior to the Great Recession, in the early 2000s leading up to 2005, entry-level housing was a viable commodity, a viable widget for home builders to build. You saw the lower price builders that had competitive, great products out there, D.R. Horton, KB Homes, even some of the other builders that didn't specialize in entry-level housing were building lots and lots of entry-level housing. Pulte, Lennar, etc. The list is long. But this time around, you even look at D.R. Horton and KB Homes, and the houses they build could hardly be considered entry-level. Hardly. They are much more expensive. I mean, is a $400,000, $500,000 home an entry-level house nowadays? Well, in some markets it sure is. It absolutely is. And I've got a couple of 1031 exchanges going myself. You've heard me talk about them. And I am trying to find replacement properties. And I've got a deadline coming up September. I think my next deadline for identification You've got that 45 days to identify, 180 days to close. My next identification deadline on one of these exchanges is September 17th. I tried to buy a house yesterday. Boom, got away from me. Lost it. Full price offer, 100% cash. They took it. Gone, gone, gone. Another property I've been looking at. Made an offer on that one. That was maybe Thursday of last week. Today is Monday as I'm recording. And wow, snapped up, gone. I just got the notification that it's pending. They made a counteroffer, $2,000 below list price. We've got one of our affiliate agents making these offers for me, and they can't get them. I just can't buy anything. So it's basically full price or above still in these desirable markets in the entry-level housing category. This article, it says, America's roaring real estate boom is leaving millions of would-be home buyers out in the cold. The problem is most severe in that corner of the market that once propelled the American dream, the small entry-level home. And here is a particular person that they profiled, a guy named Matt. He's 35 years old. He repairs and installs garage doors in and around Reno, Nevada. He says, I would like to have a space with a yard, like 900 square feet. That's no big deal. Simple cabinets, simple countertops, old shag carpeting. I don't care. I just want 4 walls and a roof that I can afford. But this aspiration for a modest starter home is completely out of reach. The country is nearly 4 million homes short of demand, according to mortgage giant Freddie Mac. Now, according to the National Association of Realtors, that shortage number, by the way, is 5.5 million. So you're seeing here different data from different sources. Freddie Mac is saying the shortage is 4 million homes, right? And again, it would depend on the price segment, the location, the housing style, meaning, is it a high-rise condo? Is it a townhome? Is it a single-family home? Et cetera, et cetera. So, investors, it looks like you have a very nice runway ahead of you because you, our clients, are gobbling up these kinds of houses, what's left of them. The pickings is slim, I agree. You're gobbling them up left and right. And guess what else? Pension funds are gobbling them up. American Homes for Rent is gobbling them up. Blackstone, BlackRock, Invitation Homes, they're being gobbled by institutions left and right. And these institutional investors are also reducing the supply in ways you don't even see. You want to hear more about that? Well, tune in next week. No, just kidding. I'll tell you right now. Okay, so what they're doing is instead of buying homes that are on the market, they are approaching the big home builders, like one that I just mentioned, D.R. Horton, and they're saying, hey, D.R. Horton, look, instead of building another tract of homes and putting a sales agent there in a model home to sell them for you, why not just sell us 336 homes, or 271 homes, or 183 homes? Just sell it to us. To Invitation Homes, we'll just buy them all. Don't even put them on the market. No need to do any marketing. No need to have any complexity. No need to hire a new home salesperson to sell them for you. We'll just buy them all at once. Bam. You didn't even notice that supply existed, did you? No, none of us did. And guess what? Because that home builder is now busy building the build for rent or the build to rent entire communities of detached homes, they have now gobbled up the supplies in the supply chain, whether it be the supply of lumber, of door hinges, of kitchen cabinets, of faucets, toilets, stair railings, light fixtures, front doors, door jambs, closet doors, closet organizers. Folks, all of these ingredients in these houses. How about the tile? How about the countertops? How about the appliances themselves? Do you realize the back order to get appliances? Go and try and buy with a good degree of selection like there used to be. I certainly know you can buy them, but with good selection and good pricing. Go try and buy a stove or refrigerator or dishwasher. Good luck. Yes, you'll need it. And yes, lumber prices have dropped. That market apparently got a bit ahead of itself, but still, overall, they are historically high. And not only this, they're gobbling up the labor. The labor is one of the most challenging portions for these builders. They just can't get the labor. They're having to pay the labor lots more than they used to. Wow, this is something, folks. This is something. That no-frills entry-level home that this buyer, Matt, the Pergens is their name, Matt Pergen, describes is just about vanishing in America. Once it was the stepping stone on a path to upward mobility for a huge swath of younger Americans, in 1982, 40% of the country's newly constructed homes were entry-level homes. 1982, 40% of all new builds were entry-level homes. Check this out. Folks, are you sitting down? Here it is. You ready for this one? By 2019, the annual share of newly constructed entry-level homes had fallen to 7%. Wow. We went from 40% of all new homes being built in 1982 being entry-level homes to only 7%. Well, 7% 2 years ago. I would venture to say it's much worse than that today. Freddie Mac defines a starter home as a 1,400 square foot or less home. There's no universally accepted description, but as a rule of thumb, think 2 or 3 smallish bedrooms and 1 or 2 bathrooms. Buying a home isn't just about gaining a financial foothold, says Anthony Alofsson. Is that how you say that? I guess so. An architect and author who has written about the American suburbs. It's a sign of arrival. It's a sign of psychological and emotional security. It has meant a huge deal for this country. By the way, if you want to compare this to other cultures, have you read or seen much about what's going on in China? It's very interesting. Do you realize that a young man in China, if he does not own a home or have good prospects of being able to buy a home, and usually a home there means a little tiny cell in a mega high-rise, super mega high-density building, right? Nothing luxurious here, folks. He literally cannot get a woman. Impossible. It's like, don't even try if you're not a homeowner. Buddy, you're just no chance of getting yourself a girlfriend, much less a mate, right? If you're not a homeowner. So yeah, that's the way it is in China. And I think that also might be true in Japan as well. Japan has got its own set of very weird things. Quite interesting. Study it. It's interesting. But I will say, I loved my visit to Japan. One of the most polite populations in the world. I just loved it. Very enjoyable place to visit. But yeah, folks, this is amazing. And one of the other things that makes this really challenging is that the new homes that are offered, you never know really what the price is. Because as soon as you go in and talk to that salesperson, the price they advertised is literally impossible to get. You can't get that price. And I'll give you an example. I have now configured a couple of new homes that I was looking for yours truly, right here in Florida. And there are giant, incredibly long wait lists. And I'm talking, I'll go up to $2.5 million in price, right? But looking at something that's $1 million, $1.2 million, $1.3 million, You configure the house, and literally you cannot buy the house at the list price. So if they say the price is $1 million, good luck. That house just doesn't exist. I don't know how these builders aren't getting sued left and right for false advertising. It's just, I don't know. I'm not sure how they can get away with it. Any lawyers out there, let me know at jasonhartman.com/ask, because I'm sure curious. You look on all these websites for these home builders, homes starting in the 400,000s, if you want to buy like a theoretical investment property. But by the time you configure the house, any way anyone would take it, it's 460,000. For $1 million house, you're going to add at least 10, if not 15 or 20% to the price. So it's going to be $1,150,000, $1,200,000 for the $1 million house. So you just, it's just very misleading. It really is. Wow, it's really something else. It's really something else. So there we go, folks. That's the state of the market. Now, I do have some good news for you. Well, actually, that is good news for you. Everything I said is good news for you. I know. It's a little bit harder to enter the market when you're wanting to buy those properties and build your portfolio. But once you're in, it's fantastic because you got the stuff that is in scarce supply. Very scarce supply. So that's the deal. Okay, good news though. Some other good news, more good news. We've got the schedule out for Empowered Investor Live, and because so many of you prodded me, prompt me, twist my arm, you were just nagging, asking for it, we have offered live streaming tickets. And this will be simple, on Zoom. Yes, you can live stream the conference on Zoom. Go to empoweredinvestor.com and pick up your live stream pass, and you can join us. You can interact. I will be making it a point to walk over to the Zoom meeting during the conference and asking you live streaming audience, if you have any questions or comments for the speakers. So we'll be doing that. Go to empoweredinvestor.com and get your live streaming tickets, or better yet, get your last minute live ticket and join us live in Orlando. We got a fantastic event shaping up. I'm just really excited about this. Let me tell you, live events are a lot of work to put on a live conference, but it is a labor of love because I just love seeing everybody. We've got a great lunch for you planned on Saturday, and for some of you, we've got a fantastic Saturday evening dinner. For all of you, we've got a fantastic band and entertainment, dancing and singing along and having a great time on Saturday evening. It's just going to be a great time. So be sure to join us, empoweredinvestor.com. And now let's get to today's guest. It is my pleasure to welcome Damian Lupo. He is founder and CEO of eQRP, host of the Transformation Nation podcast, and author of the new book, The QRP Book, How to Get Checkbook Control of Your 401k Rollover Money Now. And Damian, welcome.
Hey, Jason, it's great to be here. Thanks for having me.
Good to have you. Is this distinguish between what we're going to talk about today and the self-directed IRA, if you would? Lots of real estate investors talking about self-directed IRAs. Business owners are talking about solo Ks or solo 401ks. What are we talking about?
We're talking about a different part of the tax code than the IRAs. IRAs are in 408 and eQRP is in 401, where the 401ks and the solo 401ks live. And the big difference really is the speed and the control of your money, and the big tax that people don't realize is coming called UBIT, the unrelated business income tax. And that's what's applied when you invest your IRA in a deal that has any type of debt, and it's in an eQRP, it's actually exempt. So huge difference. And it's actually the highest taxed thing in the tax code right now.
But people will say, if I've got a self-directed IRA and I buy a property within that self-directed IRA and I find a non-recourse lender, which is definitely a specialty, folks, it's that there aren't that many of those, but I get a loan, and maybe I can only finance 50% loan to value, which is not quite as desirable as what you do outside of the plan, pay a higher interest rate, et cetera, blah, blah, blah. Then I sell that property. What's going to happen to me? I thought I just sell it and there's no tax event because nothing happens until I start to withdraw money at either 59 and a half or I'm forced to when I'm 70, right?
That's the normal assumption. And then people get a tax bill and they ask why. Even with Roth IRAs, they say, wait, this is supposed to be never taxed.
Right. Because they already paid the tax, right?
Right. It's a terrible surprise when your accountant calls you and says you have a bill. And
yikes.
Yeah. So anytime there's leverage, what happens is that the IRS says, well, this wasn't really all your money that was invested. It was partially debt, which isn't yours. So we're going to tax you. And basically all of the money that's not your money, like let's say you had 50% that you put down and 50% was private debt or hard money, non-recourse debt, then 50% of your profits would be taxed at this 37%. So, if you make $100,000 and you had half of that, of your deal was leveraged, $50,000 in profit is taxed at approximately 37%. So you do the math and you're talking about $16,000, $17,000 in tax that you didn't expect. And it's not necessary. That's the big thing. It's totally optional if you move away from the IRA and move towards an eQRP.
I don't think a lot of people know that.
100%. And it's the big question people ask is, well, why don't I know this? And where did this come from? And the reason we don't know it is because certain industries have a lot of marketing power and they're not really, they don't talk about it because it would scare people off. It's also funny because IRA
certainly true of the Wall Street crooks.
100%. Yeah. They don't tell you that there's options to control your money because they want to keep control of it and fee it to death.
Yeah.
So basically the 401k industry and pension industry had better lobbyists years ago and got an exemption for this. That's why this is exempt and why IRAs are not.
Wow, that's amazing. So this section of the code, was it sort of, you say they have better lobbyists, was it originally like larger companies that were using this and now it's more available more recently or at least more sought out by smaller investors?
That's exactly what happened.
Or smaller business owners, I should say, maybe.
100%. I mean, years ago, what happened is you had a lot of real estate developers that would go to pensions and big 401k, but basically a lot of pensions, which are under the same part of the tax code. And they said, hey, we want to borrow, we want to have $100 million or $500 million invested in this giant development. And so they said, we want to be able to do that without our investor, the big pension fund, getting taxed. So the big lobbyists went in and got this exemption. Well, now individuals have 401ks. There's all sorts from individuals to small companies. And so they get to take advantage of what those lobbyists did for the big boys. So it's kind of cool getting to use all the big lobbyist firepower, if you will, for your deal when you're a one-person band or you have a few people with you.
Yeah, definitely. So when did people start adopting like how old is this, this became a thing? And then when did the smaller people start adopting it?
So it's interesting because it's brand new. And I say that sort of tongue in cheek because this has been around since the early 70s. It's 50 years old. The individual type of stuff where people really started putting a lot of money in was around 20 years ago when it started to really catch fire. And especially after the Roth component came into play in 99, which is ironically what balanced the budget. It's all this money came flooding in where people converted it. And now you've got guys like Peter Thiel that have $5 billion in his Roth account, which nobody really knew about until recently. So it's relatively new. The wealthy are using this as one of their major tools now, and most of the population doesn't even realize it's a thing.
Yeah. Well, Peter Thiel, basically hit some huge home runs on stock options, and that's an amazing story about his Roth IRA. And everybody's screaming, "Eat the rich!" All he did is follow the rules. I mean,
Exactly.
Give me a break. Peter Thiel is the smartest guy in Silicon Valley, bar none. That guy's really quite brilliant. His book, One to Many or 0 to 1. I mean,
0 to 1 yeah.
is a great book, by the way. Took me 2 times through it to understand what he was talking about, and maybe I still don't. But he didn't use the eQRP. He just used a Roth, right?
He used a Roth, and he really didn't use any leverage. He went and just did exactly what you said. He was buying penny stock, basically. Yeah. Before things went public, went from a penny to $50, and he did that over and over, starting 20 years ago. He was very early in this, and so over 20 years, 1,700 turned into 5 billion. And now you're right, it's Eat the Rich. And all he did was use the code, and the code is available to all of us. So, it's pretty smart.
Right. Okay. So this, you say it's 50 years old, but it's new. I don't understand.
Well, it's funny because it's new to people. People haven't seen it. They haven't heard of it. It's been around. This code, the ERISA code back in 73 made 401ks and IRAs.
Sure.
And then they've been tweaked over the years. Ergota, these different things in 2002, changed the rules. And really we've gotten to a point where an individual, just one person doing their own thing, can put $58,000 per year into a plan, and multiple people in a household can do this. Like they got all of the options that were really only available to high income earners at big companies. The tax code kept changing because the government's trying to figure out how people can support themselves and not rely on Social Security.
Okay, so has it been you that's been publicizing this? I assume there's other people out there doing it too, right?
Yes, there's a lot of companies that are promoting IRAs. There are a lot of companies that are promoting individual 401ks. What we do with the eQRP, we're the only ones that do it, where you can actually grow your business as a real estate investor, or you have a business and you want to bring on some additional talent, whether it's employees or contractors. And it's a unique thing for people to be able to scale as they want to grow. And so it's really just promotion. It's sharing and people sharing through, referring their friends and saying, hey, there are other options than Wall Street.
Yeah, interesting. Okay, well, you've got some visuals to show us, and for those of you who are listening to audio only, we'll please try and explain the visuals so they understand if they're only listening on podcast, but this will be on the YouTube channel as well. So feel free to share them, and let's get started.
Awesome. So really just getting into what we were talking about, helping people understand the differences between IRAs and SEPs, and I know that you've talked about some SEPs and IRAs, that compared, so we really have black and white, what's the difference. When we talk about the differences, what we're talking about is speed, control, and taxes. And IRAs have a very limited amount of money you can put in. It's 10 times more with a different part of the code with the eQRP. And a lot of times what people are realizing in real estate deals is that you've got to be able to react quickly. If a deal comes up, you can't wait 6 weeks to fund. Like, you need to be able to fund quickly. That requires having checkbook control. And sometimes you can do that with an IRA. Sometimes it'll take you 6 weeks. It depends. eQRPs, very different because you're the trustee, meaning you are in control of the deal, the money. Nobody else touches it. And the biggest thing that we talked about before was the debt factor. There's an unlimited amount of debt. Like when I started my real estate career in 99, I took over a property, put $6,000 down, took over a mortgage of $120,000. And so I had pretty high leverage. You could use all that leverage and not get taxed. If I had done that with an IRA, I would have been hurt pretty bad with a tax. And a lot of people are doing the syndicating deals. I think this is a great example of getting involved in bigger deals to be a part of professional teams. So this was a deal that a friend of mine in Texas did, $50 million deal, and about 10 million of investor cash, a lot of that retirement money. And then there was 40 million in debt. This is an 80% leverage deal, pretty high compared to maybe flipping a house, but it's a good example of what people are getting into. And so when this property sold, it sold for $70 million. And the UBIT tax that we talk about, the unrelated business income tax, was triggered because of unrelated debt financed income. This is the tax that we talked about that will hit people. It's up to 37%. And so people that invested in this deal, the people that used IRAs paid up to $29,000 in tax. And this was not something anybody really anticipated. They just got a tax bill. The reason was because it was 80% leveraged. So 80% of their profits were taxed at 37%. And in this case, the eQRP investors they paid zero. So this is a pretty big terrible surprise. And that was a great example because those are the type of deals we're seeing a lot right now. People are cashing out and they're saying, well, crap, what do I do? There is an answer if people are already in deals, but it's something that people need to know about. It's not a thing you want to find out after the fact when you can't fix it.
Mm-hmm. Yeah. Okay. Tell us more.
All right. Let me give you another example here. And this is
80% leverage. His UBIT would have been huge on that deal.
Yeah. Making $100,000 and having 80% of that profit being subject to that 37%. You do the math, 37% of $80,000 in profit is a big number. It's in the 20s of thousands.
I sort of keep wondering to myself as you're speaking about this, why the IRS does that. When you look at the tax law, it is, nobody likes taxes, but it has a logic to it. And, they don't tax you on 80% outside of a plan. Well, I guess they do. I don't know. It's sort of,
Jason, I think the reason they do it is they're looking at this tax shelter, which is what retirement accounts are. And they're saying it's almost like an unfair playing field, that you're using a tax shelter and then you're using leverage, and it's two in your favor. And so most of the money that's invested in real estate from retirement accounts is self-directed IRAs. And so that's what they went after. They said, okay, this is all the money that's not coming in as tax revenue. So we're going to level the playing field for people that are using just regular cash and not sheltered money. That's my guess.
Yeah, right. Okay.
Another good example is people that are flipping stuff. This was a gal that came in and she heard about this deal about the eQRP, and she said, okay, we did this deal. It was a $200,000 purchase and rehab. They were selling it for $300 and closing at the end of the week, and so they had about $100,000 in profit. So the net profit after all their fees was $68,000. And she came out and she said, "Are we stuck?" And I said, "You used an IRA?" And she said, "Yeah." And I said, "Well, not exactly, because we can take that IRA and convert the asset to an eQRP before you close. And instead of paying that $20,000, it's zero. So as long as somebody converts it beforehand, before they sell the asset, so you could have an apartment you invested in for 5 years. As long as you convert it before it sells, then you can avoid the UBIT completely."
Amazing. Okay.
Let's see what else we've got here. So a lot of people are trying to figure out whether or not they can even do it. I mean, that's whether what options they're qualified for. Really, anybody can do it. The question more is whether you should, because once you have your money in your hands, a crazy person will go do what I did in 2006 and buy a Ferrari, and then that's totally disqualified. So
hey, sometimes people make money on those Ferraris.
I
not as much as they do on a property, of course, but
I wish I knew how to do that, because I just lost my butt on my Ferrari, but it was fun. I mean,
the problem with the Ferrari is the maintenance along the way. That's what'll kill you. The asset itself might actually appreciate, but the maintenance during the ownership period is insane on some of them.
Well, I'll tell you what, you buy one that's 5 years old that's never had fluids changed. My first weekend, I got a $10,000 bill for changing all the European fluids. So I can tell you're exactly right. That was my experience.
Yeah, I've had many friends that, I don't do these exotic cars. I'm just kind of conservative like that, but I've had many friends that do them, and they say, "Oh yeah, it's another $8,000 visit to the mechanic."
They don't do any hundreds of dollars. It's always thousands, and usually it's tens of thousands.
Yeah, wow. Crazy.
Yeah. Really, but truly, I mean, this is open to anybody. People have to realize that whether you're putting deals together or you've got your own business, you're self-employed, whether you're a passive investor or you've got a job, if you've got employees, anybody can do this if it makes sense. So it's not really restricted. I think there's a lot of misconceptions that you have to have a corporation, you have to have a brick and mortar or something, but truly it's really anybody that says this might work for me and my my situation. So I want people to really get that it's an option. It's not really can or can't, it's should or shouldn't. I got a great example that we'll share with somebody that the tax code changed in the last couple of years. So it went from, you have to be with taxes, you have to be very proactive, and most people are, their tax people come to them in September and say, okay, let's make sure we're ready. One of the rules changed, so you can actually set up retirement accounts, this one specifically retroactively. So this is a gal that came in the spring of 2021 and set up a retirement account, this specifically for 2020. And what was cool is we used a couple different parts of the tax code. So she made a couple $100,000, was able to put $57,000 into the plan as a deduction. And then because that brought her below the $157,000, that's the QBI, the qualified business income limit, it allowed her to take another 20% deduction off that. So her net income ended up at 115. So she went from 200 to 115, and she saved $20,000, and it was retroactive. So she did this after, in 2021 for 2020. So that was a pretty big deal to be able to go back in time, like Marty McFly.
Yeah. Wow. So you set up these plans for people, right?
We do. Yeah.
And what's involved in setting up a plan? Do you have to create a legal entity like an LLC or a corporation, or is it simply documents, more like a trust or just a business deal? What is it? What is it that happens?
So there's a number of pieces that are built. We build everything. We build the plan, the documents. There's a couple hundred pages of documents that are custom made for each client. We set up the entities. Yeah,
and I bet those couple hundred pages of documents will really help cure insomnia.
I don't know if anybody's read them. The ones that do look at them and go, why? And I said, the answer is the IRS. I don't know why some of this stuff is the way it is, but we follow the IRS. And as long as you do that, and really, It's not the Wesley Snipes approach. If you've ever heard of his story, it was like, well, I thought this was okay. You don't get forgiveness from the IRS. You get permission, which is what these have. And so, yeah, there's definitely an insomnia factor. This will cure it if you want to read the docs. But in terms of setting everything up, it's building all the docs, setting up the bank account, setting up the entities. And then really it's turnkey for the person that's using this. They end up with a checkbook where they can wire and invest, and very, very simple with the proper team. And I know you talk about this and it's important. The teams are what make people successful.
So you do set up an entity then?
Yeah, there's multiple entities.
What entities need to be set up?
So as an individual, you can be a sponsor of a retirement plan. So you could be a sole proprietor. Sometimes we'll set up LLCs or corporations for people. It's custom made. So this is not a one size fits all. And I think that's one of the misconceptions out there. It's very custom tailored for where someone's at, and it's all part of it. We build everything for.
Right, but just give us an example. Like, what do they do? I mean, you say entities. It's not even one entity. It's multiple. Correct. How many entities do you need? What's the minimum?
So we're going to have at least a couple of different entities, and potentially 3 or 4. So and so we set these up. One, you have to have a sponsor for a plan. So that's you as an individual sole proprietor. It might be an LLC, and then you have a plan, which is the actual retirement account. And then inside of that, we're going to have some entities that are going to provide some liability coverage and some anonymity, because the last thing you want to do is announce to the world that you have a bunch of assets. You become a target, especially in California, or really in America. Now, if you have money, you're a bad person, I guess.
Sure. Yeah.
So this is really about creating that liability protection and the anonymity, so you can create wealth without being a target.
Like, in what states do you set up these entities? Are they LLCs? Are they corporations?
Typically, most of the time we set up LLCs. Sometimes there's a corp. That's an exception, but typically it's an LLC. And now the most common is Wyoming. Nevada, Delaware, and Wyoming are the 3 places that most people use entities.
Really desirable, yeah. Are the entities for doing business, like doing investments, or are they necessary to keep the plan structure and make the tax advantages work?
They're not necessary for the tax advantages. They're there for the anonymity and protection and for the ease of use, because quite frankly, most people don't know what a retirement plan is, and they don't understand the structure, but they understand an LLC. And so if you're investing your retirement money into a syndication or some deal, people understand an LLC that's coming in as the investor. They oftentimes don't have a checkbox for a retirement account. It doesn't fit into anything.
And we'll be back with a lot more on this topic with this guest on our next episode.
So George Gammon, Jason Hartman, and I we've created a high-level mastermind group called The Collective. The goal of The Collective is for you to learn from the 3 of us, as well as, of course, the other members, on how to build and, more importantly, how to maintain your wealth. In this video, we're going to go into detail about what The Collective is and what it can do for you. Enjoy. So I'm Ken McElroy. I've been in real estate for over 30 years. Started with a 2-bedroom, 2-bath using my own money, and now I own over $1 billion worth of real estate that I bought over the years, built a big company. We have a construction company, a development company, a property management company, and of course an investment company. And typically now we syndicate and work with large, both private and public institutions for the equity and the debt. And so what I bring to The Collective is how to scale, how to grow, starting with one really small property with no experience at all and growing it into an organization, which I've been able to do, that basically runs almost without me. So that's what I'm going to bring to The Collective. We decided to start The Collective because, one, I met George Gammon, and George brings a very interesting perspective about the economy and the Fed and the way money works and Bitcoin and alternative types of investments, which quite honestly, I was super focused on real estate almost the entire time. And even I want to be a little bit more diverse. So when I talk to George and to Jason, they're always doing very, very different things on the investment side. Jason specifically is more focused on the single family housing and what's going on in that market, so that we could collaborate and have different viewpoints on different things. And so that's why I thought The Collective would be good, because I think everybody's kind of searching for the same kinds of answers. So The Collective means to me, basically, the collective group, the whole. And I've always been a big believer of team and collaboration. So for me, it really means collaboration of everyone kind of coming into a room and learning from each other based on their individual highs and their individual lows, and to be very, very respectful of all their independent views on things, and to be more open-minded, transparent, and authentic. So I cannot wait for the group to get together each and every quarter, because we all have very different walks of life that we're going through, and so it's very, very cool to get into one room with like-minded people. I think the right person for the collective is somebody who's into personal development, somebody who's trying to be a better individual, somebody who's trying to have that work-life balance, trying to figure out good decision-making on the investment side specifically, good decision-making on the personal side perhaps, certainly on their health and on their wealth. The members that have already signed up are people typically that have businesses that they're growing, businesses that they've started, or businesses that they've sold. So typically they're higher net worth, and they're trying to figure out what to do with their money. They're probably a little bit afraid of inflation. They're probably a little bit concerned about where to invest. And they're obviously looking at real estate as one component, somebody that's trying to do the right things both on the personal side and on the financial side. So some of the experiences that members can expect to get out of the collective are certainly the network. And I think that's always super powerful. I've been involved in groups like this before, like EO and YPO, the Entrepreneurs Organization, and YPO, which is Young Presidents Organization, which is kind of a peer-to-peer network. And that's what I envisioned, and I think people are gonna certainly get that out of there. They're gonna have lifelong friends for sure from this, and they're gonna meet people at every single event. But also, we're gonna have fun. So as an example, things like race car driving and doing all kinds of really cool things and meeting celebrities and things like that, and fashion shows are gonna be part of it. So it's kind of a, how do we have fun and learn together? And we're gonna have that at each and every event. So thanks for watching. If you guys are interested, there's a link below you can click on. It'll take you right to the website, which has a load of information on exactly what the collective is, where the next events are, and what exactly you'll be getting if you become a member. Thanks for watching.
For real estate investors, if you have 1 or 100 properties, managing them can be challenging. What you need is a solution that simplifies a complex process and gives you control while saving you money. Introducing Property Tracker, the best tool to accelerate your financial freedom. At a glance, you can evaluate, track, and manage the financial performance or your real estate. With Property Tracker, you can quickly analyze your properties and make informed decisions. You can easily track and organize all of your income and expenses along with legal documents, contracts, contacts, and your mortgages. It makes tax time a lot easier too. We simplify the management and provide you with actionable insights into the financial performance of your portfolio. Sign up for your free account at propertytracker.com today.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.